Welcome to another edition of Why Real Estate. My name is Lane Thompson. Thanks for tuning in. I'm excited about this topic. We're going to do a housing forecast summary for 2025, and it's based on information that came out from Lawrence Yun, the chief economist for the National Association of Realtors. And he starts by citing an article in the New York Times that came out yesterday, and it is titled, "Can the U.S. Climb Out of Its Unprecedented Housing Crisis?" And there was a particular paragraph in that article that says, "The story of the 2024 housing market has been one of a nation frozen in place, with millions of people unable to move amid rising home prices, stubbornly high mortgage rates, and a drastic shortage of inventory. The year is on track to have the slowest housing market in 3 decades, with a projected 4 million in home sales, according to the National Association of Realtors, making 2024 the second straight year of historically sales. The last time sales dipped that low was in 1995, when the U.S. population was 22% smaller than it is today." That is so accurate on what we're dealing with. And I want to go through some slides with you that you can see here that we're sharing that highlight, what are the facts, what has happened this year, where do we stand, and I want to jump right into it, okay? This first slide is household equity in the United States. As you can see, back in 2012, it dipped below a cumulative total of $10 trillion, and it has absolutely just skyrocketed up towards around $36 trillion over these last 12 years. Owning a home and owning real estate, we've just never seen anything quite like that. Here's another slide, and I've highlighted this on other podcasts that I've done, that talks about the median net worth of a renter versus a homeowner. Just 5 years ago, the estimated net worth of a renter was $7,300, and that of a homeowner was $295,500. And you can see it escalating. 3 years later, in 2022, $10,400 for a renter and $396,200 for a homeowner. And then you can see that a renter's net worth on average, or the median net worth, has gone down to $10,000 today, and the net worth of a homeowner is at $415,000. You can see the breakdown by median net worth by age groups. So a lot of this, if you're younger, don't be easy on yourself. Okay, it takes time to build that kind of net worth, but you can see that the older you get, obviously the more net worth you have, and once you leave the workforce, you get into that age range, then typically you'll start to see your net worth come down because you're obviously living off of those retirement funds or whatever you've done, that help you create that wealth to live off of. As far as delinquent mortgages, see, a lot of people ask about, hey, when are we going to see these delinquencies and these foreclosures and these short sales come up? Well, it's just not going to happen. I mean, you look at 2008 and 2010 to 12 in that range. I mean, it was so high, these delinquencies. But now people are locked in at such a lower interest rate, they have very little interest in letting their mortgage go delinquent. And you can see how low they are come 2024. As far as the housing crisis of low existing home sales, these last 2 years were 2 of the most difficult as far as the number of sales that we've had, especially when you consider that there's 70 million more people living in the United States than there was even 30 years ago. But you can see that it's just above 4 million each year in 2023 and 2024. As far as the Fed's cutting rates, okay, there should be 4 to 6 more rounds of rate Fed cuts in the next year. This doesn't necessarily mean that we will see a direct correlation with mortgage interest rates coming down as well. Again, there's multiple factors that go into that. I did a video on this already. If you want to see approximately where those rates are, they're going to be about 2 to 2.5 points higher than what the 10-year Treasury yield is, okay, from buying U.S. treasuries. So that's a better way to track it. But rates may not fall because if inflation stabilizes and economic indicators are stable, they're really not going to bring down the rate that much. As far as national debt, I mean, this one is just staggering. From 2006 or 2002 even, here we are around 6-7 trillion, and now it is up over $36 trillion, which, to service that debt is a tremendous feat for any government to be able to do, and it's going to soon start taking up a ton of the GDP of the United States. I'm all about DOGE, okay? Department of Governmental Efficiency. I think it can be a huge benefit to everyone, and I hope they can do what they can. And that doesn't mean that we don't, I want to see people who I know work in the government without jobs, but the strain on the system for all of us is more than we can bear. So as far as moving away from the dollar, yeah, that's absolutely happening, as you can see with the Trump bump when it comes to cryptocurrency. I mean, gold, I just sold some gold a couple of weeks ago, made a good return on it. It's getting upwards of $2,600, $2,700 an ounce. And people are moving their money into gold, into cryptocurrency. As you can see, Trump was elected, it was around $67,000 for a Bitcoin, and now it's over $100,000. And obviously real estate is another great thing to put your money in with the devaluation of the dollar. I love this next chart because it eliminates kind of the pandemic itself, because it shows the job growth by state from March of 2020. Remember, it was mid-March when all of a sudden we just went to a stop because of people being so fearful of COVID, government mandates and whatnot. Well, now we see from March 2020, the job change growth and percentage in each state, and it's been stable and strong. You can see that there's certain states like Idaho, Montana, Utah, Nevada, Texas, Florida that have seen tremendous job growth, and I like that because, again, it eliminates that blurb, that one off, the outlier that was caused by COVID. Then existing home sales, interesting graph as well, is it was continually going up year over year. Okay, this is a percentage of the month the previous year. Well, we finally saw in October of 2024 there was an actual increase percent change from home sales. Great sign overall, and hopefully that can continue. As far as inventory, available housing inventory, and it goes to this speaks to that New Times article that highlights how high prices are so high, yet inventory is low, and we have this massive amount of home buyers waiting in the wings to be able to hopefully be able to buy and afford something. Well, it exacerbates the problem when you have a low inventory for people to, obviously makes it harder for people to choose from. As far as the national forecast, you can see those numbers there on that slide. Existing home sales, they forecast, will be 7 to 12% higher this year, 10 to 15% higher in 2026 than 2025. New home sales will be up. Median home price will increase by about 2% next year, and mortgage rates, they're predicting, are going to hover around 6%. And we will see significant job gains during that time. So here are some important local factors that cause variations in the housing market. As you can see listed here, fewer locked-in homeowners and more inventory growth of starter homes, more first-time buyer age and higher income millennials, largely can be determined by a job market. Like here in Utah, we've got a thriving tech sector, many businesses coming here, so you can see that you may have a lot of those higher income millennials that are moving in. Also, slightly lower mortgage rates could happen, by area or region. Faster job growth, I think that goes without saying how that can affect the market. Positive net migration. In Utah, there was a time when we were in Utah County alone gaining over a net of 1,000 people a month. And I wouldn't necessarily say it's slowed down that much, but in talking to colleagues and others, it seems that many people, especially with the higher default rates and eviction rates when it comes to renting that are occurring, it seems like without people buying, people must just be hunkering down with family until they can finally afford to buy a home. So more and more people are compacting into homes, and because we have higher eviction rates on rents and lower sales in homes, obviously lower inventory, so this is all pointing to that kind of thing. And then obviously, local housing wealth that people have built up, equity in their home to be able to help them put towards the next house. Hey, thanks for tuning in. That is a very comprehensive overview of the overall economy and its effect on the housing market. If you like our content, please like, share, and subscribe. And comment below on, I'd like to know your thoughts on what you think the housing market is going to be like in 2025 and what are your biggest concerns.